How's it going, everyone? It is Andre Williams, and in this video I'm going to be giving you guys a 2-for-1 special, but I'm going to be talking about Zomedica. We already know that there's a big time catalyst that's going to be coming. I'm going to be going and talking about that in this video, and I'm also going to be doing a technical analysis and some things that you need to consider and you need to look out for. With ZOM, it has definitely been on a big time run up. As far as the average cost that we have, it's around $1.15. One of the things I want to let you guys know are some of the risk and some of the rewards that are involved. And there could definitely be a potential situation where it could definitely be a risky investment because you're really betting on that catalyst to actually turn out and do well, especially for the long term. I love what it's about. I love the product and so forth. But hey, the market is going to decide as far as the veterinary space and so forth. But hey, the bonus one now is a stock that I've talked about on this channel, but there's a lot of big asset management firms that are actually in it. I cover it in the video, and I'm going to do it again because it's actually one of the few penny stocks that have a big long-term potential, and you could definitely easily double your money, especially after the pandemic is over and the vaccines get rolled out and so forth. Now, I won't waste any more time, so let's get into it. All right, so we're going to be doing a quick technical analysis on Zomedica. As you can see, it's on a definite run that we saw here. As you can see, from January to 4th, making a strong move all the way to $2.91 on February the 8th. One of the indicators that it's been riding very well is the 21-day EMA. As you can see, it's just this bright type of color. I wanted to use that so you guys can see that clearly. So it's done a great job on that uptrend, as we can see, and now we see it right on the line here. So usually for anyone who's looking for a short-term trade or a swing trade, this is actually not a bad place for your position. Usually when it breaks trend and it goes below that 21-day EMA, that's usually where, the trend is broken and you might want to start thinking about which particular area you'd want to set up a stop loss. But if you were to set up, let's say, one here at 175, it would take you out right away, especially if it hit down here to $1.33. But you do end up protecting a lot of your money. So here's one of the things where we need to understand. The market was pulling back very heavily. We do know there's a catalyst that's going to be coming at the end of March as well, which is the Truforma system. And if everything ends up doing well and it gets a lot of good attention initially, then we could definitely see ZOM being a great stock to hold long term. But we also got to understand this could be another situation where we buy the rumor and we sell the news as well. So what this means, even around this particular area where it closed at $1.87, I know it did go to $1.98 in after hours on close for Friday. One of the things we want to see is a move to the upside, especially knowing that the March 1st starts actually on Monday. So taking that into consideration, I would love to see Zomedica reclaim 220, 240, 260, and once 260 comes, and if it can make that move to 280, I'm definitely looking to move to $3. That is a perfect best case scenario. But again, do not be surprised if the news drops and then it ends up selling off, because a lot of people are in this stock for that same reason. If we take into consideration what the average cost per share for each shareholder, amongst all shareholders, it's around $1.17. So that's something to really consider, and it's part of the reasons why if we look over here on the 50-day SMA, it's at $1.14, and the fact that the average cost is $1.17, this is a risky play. If you want to put in a stop loss or you want to have some sort of risk management in place, just know you do risk yourself being taken out of a trade because this is a penny stock and it can move very quickly. But again, at the end of the day, having a stop loss is not a bad idea because it does end up, protecting your money, right? Protecting some of your capital when you do lose some money as well. Anyone who got in fairly early during the run-up, I know many of you got into $1. If you got into, let's say, like the 50-cent range, that's a great area as well. And if you see long-term that ZOM is going to be doing well, the Truforma system is going to work well for them, they're going to grow and so forth, you are in a good position. Anyone who's probably bought at the top here around the 270s, the 250s, the 260s, I would honestly say, hey, wait and see if there ends up being a run-up. There's a good chance there will be. I'm not guaranteeing it, but I just wanted to show you guys that, all right? If you're looking at this long term, and if you do believe in ZOM and you want to pay around these areas, as we can see from the RSI, it's really not that bad. If you're able to catch it when it does a dip, whether it's at $1.40 to $1.60s, then by all means you can add there as well. Those are safe areas. Hope you guys found this helpful. All right, so here's the catalyst for Zomedica that's coming at the end of the month on March 30th, and it's Zomedica signs a Truforma distribution agreement with Miller Veterinary Supply. This is what a lot of investors are looking forward to. One of the things we need to take into consideration here, it's still a good amount of time away, and it's part of the reasons why buying the dip on Zomedica is really not a bad idea. As far as what we can look forward to is this. A veterinary health company creating point-of-care diagnostic products for dogs and cats, which is Zomedica, announced that it has signed an agreement with Miller Veterinary Supply for the distribution of Truforma, Zomedica's first product planned to begin sales on March 30th, 2021. Miller, one of the veterinary industry's fastest growing businesses, was established in 1920. So this company has a lot of skin in the game, all right? I love seeing this. And now is the oldest wholesale veterinary distributor in the United States. Again, this is a big opportunity for ZOM. The company currently is managed by a group of veterinary industry veterans. Remaining small and independent allows Miller to provide exceptional customer service by employing knowledgeable people who know how a practice functions by being very flexible. Not content to rest on their 100-year history, the company is growing rapidly and expanding aggressively. Under the terms of the distribution agreement, Miller will be representing Zomedica in states ranging from Texas to Maine. Concentrated in the eastern and mid-eastern portion of the United States, as previously announced, they will be supported by several Zomedica sales employees in the field assigned to work with Miller sales representatives to enhance the level of their customer service provided relating to Truforma. Zomedica currently is recruiting these support representatives as part of the commercialization preparation. Again, this is a very, very big catalyst. Part of the reasons why it might be a good idea for anyone who is interested to take advantage of this dip that is currently going on in the stock. That's what I wanted to share with you guys in regards to ZOM. As you can see right here quickly, just going to do a quick technical analysis on DriveShack. As far as for my average cost, what I currently have, it's around $2.39. As you can see from the chart right now, we have the 3-month 1-day chart in front of us. There's some strong support here at $2.40. Like, do you see that? Look at that. We have strong support at $2.40. And this was actually the price where they had for their offering not too long ago, which is part of the reasons why you see it went from $3.65 and then started coming back down. It has been trying to retest that $3 range, but it hasn't been happening because, as you can see, that is definitely a form of resistance. But I'm definitely not concerned. As you can see, if we go back all the way in November, like, look how well it does in regards to riding on the uptrend and staying above the 21-day EMA. So that's something that we really can't complain about. And it literally stayed in that area for quite some time, from the 30th of December all the way through here to January 25th. Then we had the catalyst with Roy McIlroy and so forth. And then that ended up bringing it up to 365. And then they announced a public offering, which brought the price down. So like I said, my average cost is at $2.39. Anywhere at $2.40, you really can't go wrong. But as you can see, it's a very, very strong support area, and it has been for quite some time. Where it is around $2.61, that's not a too bad of an area as well. It's definitely seen lows on the day on the Friday at $2.44. So that's if you're looking to get in maybe a little bit more of a better position, a little bit cheaper, you know what I mean? If you really, really want to make sure you're getting a good deal. But besides that, it's done fairly well ever since the market has had a pullback as well, right? Like, take a look, like, considering it's kind of started near February, it hit that high. It's kind of come down a bit, but it hasn't dropped down dramatically. And these are one of the things you want to look for. Considering it is a penny stock, yes, it's a golf course company, but just imagine after the pandemic, after COVID, kind of like we get more of a control, vaccines start coming out, I could definitely see why analysts are saying that, you know what, this stock should be worth at least $5, and it could definitely get past $5 and so forth. So I'm definitely looking forward to see what happens, but it's doing very, very well. And if you are considering to take a look at it, I would. It's a great long-term hold. You put it on, and then you just forget about it. All right? Hope you guys found that helpful. Oh, before I go, as you can see here on the RSI, it's literally sitting in the middle of 50. We already know if it's at 30, that means that it's being oversold, right? And if it's at 70, that means it's overbought. So it's literally smack dab in the middle. So if you're able to even get anywhere in that 240 range, that's a prime opportunity. All right, so now we're going to be going over this recent article on Dallas Innovates, where it says Drive Shack is bringing its high-tech mini golf concept to Dallas this summer. All right, so Drive Shack is reinventing itself, partnering with Professional Golfers Association star Rory McIlroy and shifting its focus from large golf course management to high-tech mini golf. What was once the world's largest golf course management company, now Drive Shack is moving forward with plans to debut its brand of miniature golf venues that will include tech-enhanced indoor putting, entertainment, and upscale food and beverages. The Puttery will combine auto-scoring technology with the social nature of mini golf in an upscale, lively cocktail environment. The first of the venue is set to open at the Colony, a high-end Dallas-Fort Worth development. It's basically Top Golf meets mini golf, writes Hill Anderson in Golf Inc. Last month, Santa Monica, California-based Drive Shack had an initial public offering during which it met its goal of selling $50 million in stock. At the same time, the company announced both its expansion into the mini golf industry and its new partnership with professional golfer Rory McIlroy, a four-time major champion, two-time FedEx X Cup winner, and first place ranking holder of the official World Golf Ranking. McIlroy became interested in the idea of golf-oriented entertainment options for adults, leading him to enter into a non-binding agreement with Drive Shack to help create, invest in, and launch the Puttery. The creation of the Puttery brand is a strategic one, influenced by the disruption in the golfing industry as a result of COVID-19 pandemic, as well as by increased demand for social and active entertainment options, according to Drive Shack. The company has said that their indoor putting venues decrease the cyclicality of its originally more seasonal demand and require less space, which in turn provides access to more densely populated areas, improve capital efficiency, and more. While traditional Drive Shack venues cost $25 to $40 million, Puttery venues cost $7 to $11 million, which contributes to an increase in development yields from 10 to 20% for Drive Shack venues to 25 to 40% for Puttery venues. Drive Shack's growth plans to also go beyond this summer, having previously stated that it hopes to have 5 Puttery locations by the end of this year and 10 by the end of 2022. Once COVID-19, this is what you guys need to take a look at. Once COVID-19 is under control, the ability to combine high-tech mini golf with high-quality food and beverage menu will make Puttery a great experience for any social gathering, said McIlroy in a statement. I am personally making a financial investment in the growth of future Puttery venues across the country and can't wait to debut our first Puttery in Dallas this summer. All right, so we're on fintel.io. I wanted to show you guys the institutional ownership and shareholders for Drive Shack and some of the names that are actually invested in this company. And you're going to recognize and see that many of these names are very well known. So we have BlackRock Inc., which is one of the biggest asset management firms in the entire world. They're currently holding 1.4 million shares. We also have Vanguard, that's holding 2.6 million shares. We also have Morgan Stanley, that is holding 3.4 million shares. And there are so many other firms, as you can see, that are holding millions upon millions of shares of Drive Shack. We also see some recent ones as well, which would be new. And you can see the date here, February the 16th, and a combined almost 10 million shares divided amongst American Assets Capital Advisors and Price T. Rowe and Associates. So again, very, very great company to take a look at. And it's one of the penny stocks that I actually could see with a long-term outlook. And it's part of the reasons why I have a position. All right, so those are the two stocks, penny stocks to be exact, that I wanted to go over with you guys. The potential for these stocks to move is big. But what really separates both of them, Drive Shack is definitely good for long term if you're looking towards holding it. Knowing that, hey, as soon as when things get rolled out in regards to the vaccine and getting past the pandemic and, just going back to normal, it definitely has a lot of potential to get to above $5 easily. And there's a lot of top analysts who believe this as well. And it's part of the reasons why you have a lot of big institutions that are invested in Drive Shack. And then for Zomedica, you're really, really investing on the success of Truforma. If it doesn't end up being a success, there's a lot of downside risk here, which I've already went through in the technical analysis portion. But if you are bullish on ZOM, you believe in the company, and you know that the system is going to do well, which I hope it does as well because I am a shareholder, then there's definitely room for some big time upside, especially in the beginning for anyone who might be a swing trader or a short-term trader wanting to get a position. I also want to put in the disclaimer, I'm not a financial advisor and this isn't financial advice, so just know when you do invest, you're doing it at your own risk. I'll be talking to you guys soon. Peace.